That's where we'll start with Jason Calacanis, tech investor, Inside.com founder, Robinhood angel. Jason, I remember, what was it, a year and a half ago, Bill Gurley was gathering with investors in Silicon Valley saying direct listings are it. They're for everyone. They're the future. I mean, that's not what's happened here. Is it a better public debut and IPO market than it was, though?
Well, I mean, we had an IPO window that was closed for, what, a decade? And the idea that companies would go public, during that 2010 period wasn't even on the table. And we weren't even talking about it in Silicon Valley. And, Bill's been at this for a couple of decades, 3 or 4, in fact. And we now have this opportunity for companies to go public. We have opportunities for companies to raise money. And what a savvy founder does and what a savvy board of directors does is when the market is hot, you raise capital and you deploy it when the market is not hot, right? And so the smart move is really to raise money now and deploy it whenever there's a pullback. Those dollars that you raise now could be worth 2 or 3 in the future. And we saw that at the dot-com bust. We saw it in 2008 in the Great Recession. So here we go again. We're at a peak market, and it's going to correct at some point. And the smart move is to get public now and to ride it out. So now that we have 2 choices, direct listings and SPACs, that's nice that there's
2 more
multiple
choices.
options.
Is it healthy? Is it good? Because, I mean, I see companies coming public through SPAC. It seems to be a lot of the smaller companies usually. I mean, Grab's an exception here. There have been a couple other exceptions. But it's the type of companies that 20 years ago we saw coming public early in their life. And, ordinary investors had a chance to do some analysis, maybe make a good buy. Like everybody looks now at Amazon. And even Jeff Bezos was touting in his shareholder letter, the couple that bought it really early. I mean, sure, there are a lot of bad SPACs out there, but there's some good opportunities.
Yeah, absolutely. And, people are looking for some kind of alpha, some kind of return. People want to get big returns. People are not interested in making 7 or 10% a year. People want to make 7 or 10% a day, a week. We've kind of lost the script here. And so you have people investing in anything like Dogecoin, Bitcoin, SPACs by companies that have failed. Like I think Fisker failed 2 or 3 times and now they're SPACing again. Like how many times does that brand need to fail for people to not buy the stock? And I'm not dogging just on them. There is a whole cohort of electric vehicle companies that are 2 decades behind Tesla and now obviously Ford and GM and everybody catching up there. So, buyer beware, do your research. And if you want to play in the private market game, in overvalued SPACs, and many of them are overvalued, you better be in it for the long haul and you better do your research. And now if you're buying Netflix or you're buying Disney and they have 250,000 people subscribing to their service, you can feel a lot more secure. So this is the great education that has to occur. And that's part of what CNBC and these online discussions, this is why they're so important, is for us to say Netflix and Disney are different than Fisker and Nikola. It's very, very different. When a company does not have a product in market and they become worth billions of dollars, like this company, Theranos, I always save this t-shirt, it could be a fraud. It could be a zero. It could be incompetence. Or, maybe there's a chance that you happen to hit lightning in a bottle.
Right, and some key differences, right, between the traditional IPO and the SPAC. So, Jason, for SPACs, who's doing the due diligence or who should be?
Yeah, well, I mean, obviously, anybody who buys the shares and anybody who's involved in the company or anybody who's involved in the deal should be doing diligence. So everybody from a retail investor
what about the
to the promoter.
Role?
Yeah, of course, the promoters are super responsible. And so,
but
Jason, if you look at somebody, hold on. You asked me a question. Let me finish the answer. If you're looking at somebody like Chamath, who is active and who is at the top of his game, and obviously we're besties, so take it for what it's worth. There's somebody there who's going to be keep working on this for 20 years. Then you have people who are retired or who are celebrities, and those people are very different. Yeah.
Okay, but Jason, you bring up Chamath. And so he was the sponsor. He did a lot of this due diligence, but he's also selling shares. The person doing due diligence is also the one selling. Isn't there a conflict of interest there? Do you think that there needs to be a longer lockup period? You say that he's in it for the long run, but it's not really putting his money where his mouth is.
Well, I mean, I think it probably depends on the company, and all of this is public information.
Well, I'm talking Virgin Galactic, and you saw Richard Branson do the same thing.
Right. So I think if you see a company where people are selling, you have to dig into that and understand why they're selling and if they're bullish on it or not, or things have changed. So, Goldman's taking companies out, Morgan Stanley's taking companies out, everybody's going to take companies out. And then, it's a great idea for people to have to hold for a period of time. Sure. And that's part of this push and pull, in the ecosystem. Me as an early stage investor, I really hold my positions for 10, 20 years. And so people who want to be an LP in my funds or work with me know that I have that philosophy. Other folks are taking things public. They bring it to market. It's up to you to determine if you want to be in this. And so the things that get me concerned is obviously not Chamath selling some of his Virgin position because he's doing so many other deals. I would be more concerned about a celebrity or a retired person coming out of retirement to get that one last payday on a company that doesn't have a real product or doesn't have customers. So, but it is your responsibility. Yeah, Jason. I know talking about personal responsibility is something we don't do anymore. But if you're buying Bitcoin or Dogecoin or SPACs or any stocks, it's your responsibility. Just like it's your responsibility if you go to Vegas and you put it on black or red on the roulette table.
It's a great point. I mean, we're here to help you understand, but we certainly we don't want to be in the business of being a babysitter. You're gonna make those choices for yourself. I do want to ask you, Coinbase was yet another example where viewers wrote in and said, aha, here we go again, a name that I would have loved to have gotten into earlier. Instead, I'm gonna have to watch it pop $100 at the open, and it's gonna be too expensive for me. You talk about risk tolerance. What do you tell those viewers?
I had this conversation recently with somebody very close to me, and I said, if you love the company and you were going to allocate $10,000 for it and you're passionate about it and you believe you're going to hold it for a decade or two, dollar cost average, you could buy it 3 or 4 times over the next year. We know these things are volatile. We saw Uber, which obviously I was very connected to, go down to $15, back up to $60. This is a pretty volatile market. And if you believe in the company, you believe in management, slowly get into the company. Now, you look at something like Coinbase, Brian Armstrong is the real deal. He has been an advocate and he's made cryptocurrency really easy for people, right? So he has really done a tremendous job there. But keep in mind that there was a perfect storm for Coinbase. Stimulus checks being dropped everywhere, people not being able to bet on sports, and a pandemic where nobody could go out and spend money on a vacation. That's all going to reverse, right? So now we're going to have the opening. People are not going to be spending their money on crypto as much as maybe going to Coachella. And so that crypto to Coachella transition could be bumpy for them. So, but I do think they will be I do think there's a chance they'll be Google. They'll be Google. But they'll be the Google of crypto.
I keep hearing that, and I push back with, how do we know they're not the Yahoo or AOL, because they are early. And I wonder this about the narrative, because you're an investor in Robinhood too. It seems to me that part of the Robinhood narrative is the retail investor doesn't like fees. Easy access is good. The competition is good, right? But then at the same time, you've got Coinbase that's got some pretty high fees, and the argument is that somehow they're going to be able to maintain that and maintain the margin. Can both be true, or is there going to be this difficult period where Coinbase is probably getting hit on those fees decreasing from competition, and maybe it's not clear yet what platforms they're going to be able to build on for the future?
Yeah, there's really 2 parts to that question. One is like the cult of imaginary money, and can that sustain itself? Is it a giant Ponzi scheme, as some people believe, or is it the future? Let's put that question aside. To your point of, is it Yahoo or is it Google? Is it Tesla or is it Fisker, et cetera? I think as long as Brian is in the pilot seat, this is a Google, this is a company like Facebook with Zuckerberg, you have that founder authority. You mentioned AOL and Yahoo. When they took Steve Case out, when they took Jerry Yang out and David Filo, those companies were run by professional managers who ran them into the ground. And I think Yahoo had 5 CEOs in 6 years or something insane like that. So I always look for the founder authority. I think that's the big tell. If you have a founder running the company, Steve Jobs, he leaves for Next, he comes back, you see the correlation. So as long as Brian's running the company, I would be pretty confident in it. But I do think there's 2 games being played here simultaneously. There are people who've been in the markets, and we look at them as like this, beautiful cathedral with rules and decorum and a process. And I think CNBC and the venture community and private equity, we all kind of fall into that bucket. And then there's people who look at this as betting and recreation. And they are playing a metagame they look at shorting stocks and coming over the top and GameStop and Dogecoin. This is all a big joke and fun to them, and it's gambling. So they're betting on sports. They're in a casino having drinks and having fun, and we're all taking it seriously for our retirement. And these two things are happening at the same time, which is why there's this confusion.
Jason, that's a great way of breaking it down. I give you credit for that one. Is there anything more representative of that betting recreational sort of fun side of gambling or playing the market than Dogecoin, right? We've seen this enormous spike this week, but I wonder, are there people who aren't understanding the joke, whether that be on the institutional side, who could see this as part of a problem with the wider system, or, the retail investor side that think it's an actual investment?
I have been on CNBC with you sounding the alarm, asking people to please be careful, to keep 1% or 2% of their net worth in these things, not 90%. We have Pomp on, who's a Bitcoin maximalist. He's got 98% of his net worth in Bitcoin and just one cryptocurrency. Like, my message for all those folks is buy your house, put the maximum amount into your 529 and get your kids' education paid for. And then, make this half or a third or 10% of what you're doing. But, you can't stop people from doing what they want to do. This is a free economy. You get to place bets if you want. And part of the fun they're having is watching us react to this. They love the fact that we're sitting here going, why would you buy AMC and GameStop? These companies are dying. It's a pandemic. This makes no sense. They like that. And now it's become manifest destiny. AMC is going to raise a bunch of money, and GameStop might actually figure this out. Yeah. So now it's become this crazy cult religion, and they're empowered. So what are they going to do next? Bring back the Palm Pilot? I mean, it's getting crazy.
Hey, it could happen. and never said it wouldn't work. Just said recognize the risk. That's the beauty of the market. If you see the chance, you can take it. And you, Jason, always keep it 100. Love that. Love to have you help.
Buy Disney. Buy Disney. Please own some Disney. It's not going anywhere.
Yeah.
Captain America will be here in 50 years.
Says the angel investor. So you do your share of risk as well, Jason. Thanks.
Yeah. My pleasure. Thanks, everybody.